start. Well, but lots to talk about in terms of cues for the day.
Oh, absolutely. And let's kick this off with the global setup. Mark Matthews of Bank Julius Baer and Company is now joining in to take us through exactly that. Mark, great to have you with us here. Thank you very much for your time. I don't know if you have a sort of near-term view, Mark, looking at the price action from last Friday in the US. Equities bounced off the lows. Yields sort of looked like they were threatening to break out above the turn of the year highs at about 3.9, but they ended lower. And the dollar also pulled back from the highs. Possible that we perhaps see a bit of cool-off consolidation and not up and up, at least in the yields and the dollar market? What's your sense?
Well, my sense, Prashant, is that it does all come down to inflation. We thought we'd put the inflation argument behind us, and it was a 2022 story. Unfortunately, it's still very much a 2023 story because the U.S. economy is simply not behaving in the way that anybody thought it would. It's incredibly strong, and the retail sales for January proved that point. Particularly, I thought what was interesting was the huge increase in spending in bars and restaurants, up 25%. So Main Street America is really doing well. Totally contradicting all of those lead indicators that were telling us we're going into a recession. And therefore, people are thinking that inflation will remain high and the Federal Reserve will be tenacious in raising rates. So simply put, I think that if bond yields continue to rise on the idea that inflation stays high, stocks will give up all their gains. But if they roll over, then I think stocks will keep their gains. And to your point that the 10-year failed to breach the 4% level yesterday, to me it looks like that most important benchmark is indeed rolling over. Now, having said that, let me also add that historically, the period from November to the middle of February has been the best for stock market returns over the years on average. And of course, we just passed that last week. Now we're the 21st of February. So we have exited that seasonally wonderful period of the year. And I think putting it all together, we're in a consolidation phase, which means we either go sideways or possibly down a little, but I just don't think very much.
So this is a consolidation phase, Mark, that India has been in for a while, right? I mean, this year, so far, in the last 2 months, we've done nothing much on the headline index. The sentiment is a bit on the lower side as well, and bulls are on the back foot. Do you reckon this could be the order of the day over the next couple of months? And what is your investment strategy now?
Yeah. Well, there were two things, weren't there? First, there was the whole Adani imbroglio. And secondly, there was the inflation, which in India also remains higher than what we had hoped and what we were comfortable with, and so suggests a more hawkish RBI. I don't mind that, either of them, actually. I think the Adani story is moving in the rearview mirror already. And I do firmly believe that commodity prices will remain well-behaved and eventually come off. I mean, natural gas prices have collapsed in the Western world. I don't know if you've noticed that. And so I think that inflation globally will trend to the softer side. And I don't see those two things which are responsible for India having gotten off to a fairly mediocre start persisting through the rest of the year.
All right. Hi, Mark. Mark, whenever you join, we talk about India, China, the US markets, but a couple of these European markets are doing well. The FTSE's made fresh high. The CAC as well has, moving to record highs out there. Any view on the European markets? They're quietly moving up.
Yes, I've noticed that too, Nigel, particularly the UK, and I can't comment on it. I apologize. I mean, it is a very commodity and financial heavy index, the FTSE. And so if those are going up, I can't really explain why. I don't know. I mean, possibly the view that higher rates are good for financials. Sorry, I can't answer that question. But for the record, let me just say that we don't really like European stock markets with only two exceptions, which are Sweden and Switzerland. And I know they're small, but they're excellent. They have high quality companies that are either number one or number two in the world in what they do. And they have a long history of treating minority shareholders with respect.
Mark, it's the market's job to think price in things very quickly. And in that sense, the Russia-Ukraine war is a year old. but also because it's kind of now in the backdrop, right? I mean, it's continuing, and we hit the one-year mark this week. Could that throw up surprises, you think? I mean, through the course of this week and the next few, in terms of how they impact markets, does that become relevant again? Yeah.
I think it does become relevant. Unfortunately, it's moving in a bad direction. During the Vietnam War, this is what they called the quagmire of war. Quagmire is like a sticky mud that you get stuck in, and you make one small decision which seems reasonable at the time that leads you to another decision which also seems reasonable, and sort of a whole sequence of little decisions, and before you know it, you're stuck in the mud and you can't get out. So 2 weeks ago, there was a red line in the sand that they were not going to sell F-16 fighter jets to Ukraine. And now Chris Coons, the Democrat senator for Delaware, who's also a close friend of Joe Biden, said at the Munich Security Conference that they're going to sell F-16s, or I guess give F-16s to Ukraine. And at the same time, Wang Yi, the foreign minister of China, is in Moscow today. It's not moving in a good direction, and I think it's going to expand potentially exponentially if NATO really is serious on countering Russia bullet for bullet. And it's not good, I agree.
Okay, all right. Mark, we leave it at that. Thanks a lot for joining in and taking us through your views. That's Bank Julius Baer. Let's slip into a quick break. On the other side of the break, our entire research team will be joining in to help us with a list of top 10 stocks. Stay with us.